For this mock exercise, we're going to take a look at a company called Northland Corporation. And for this case, we're going to take a look at the concepts between cash versus accrual basis of accounting. So before we actually get into the question, let's take a look at the concepts. So the general concept is cash basis of accounting means that we record revenue and expenses when cash is received, irrespective of whether it has been earned or we've actually incurred the expense. So it's really when we pay for expenses, when we receive cash with respect to revenue is when we record it under the cash basis. Under the accrual basis of accounting, we recognize revenue, expenses, assets, and liabilities when the transaction that causes them to occur, not when the cash is received or paid. And of course, the accrual basis of accounting is what's required under GAAP, and GAAP could mean IFRS or ASPE. So to give you an example, when we purchase supplies, and let's say we purchase supplies for the upcoming 3 months of operation. Under the cash basis, those supplies that we purchased are recorded as expense. And of course, we record that as an expense, let's say in the month of January, even though the consumption of those supplies happens to be for the next 3 months, January, February, and March. But under the accrual basis of accounting, when we purchase 3 months worth of supply, we would record that as an asset when we purchased, because the expenses or the consumption of that expense, the benefit associated with consumption of that supply, will not happen until January, at the end of January, February, and March. And essentially, that's what the accrual basis of accounting does. It allows us to defer the purchase of those supplies to an asset and, of course, recognize it when we consume the benefit. Another example is insurance, and that's what you'll see a lot in different textbooks and different exercises. So when companies pay for the insurance, a 12-month insurance, they will pay for that, let's say January 1st. Under the cash basis, we're going to show 12 months worth of expenses in the month of January, whereas in the accrual basis of accounting, because that insurance is for a 12-month period, we can set it up as an asset, and then we'll recognize part of that asset into an expense each month as the insurance expires. Okay? So that's essentially the difference between cash and accrual basis of accounting. Let's take a look at the question. So this question is a company called Northland Corporation. And Northland Corporation shows that they've collected $156,200 worth of cash from customers, and they paid $107,800 for operating cost. If Northland followed accrual basis of accounting, it would report the following end of the year balances. So what we're given is year-over-year balances of certain assets and liabilities, and these look like current assets and current liabilities. And what we're asked is to determine what the net income is, assuming they use a cash basis of accounting for 2009. Part B says, what would our net income be if they use accrual basis of accounting? And of course, Part C says, what method would you recommend? Now, in looking at this question, it's a very difficult question because all we're given is the cash received and the cash paid. And what we're trying to do is convert it to accrual basis of accounting. So let's first answer Part A. So Part A says, what is the net income or net earnings on a cash basis for 2009? And that one there is fairly easy because we know under the cash basis of accounting, revenue is equal to cash received and expenses equals to cash paid. So to answer part A, under the cash basis, net income, so I'll short form that to NI, or net earnings, equals 156,200, which is cash received, minus 107,800. So the net income is 48,400. Okay? So that answers part A to the question. So what is the net earnings under the cash basis? Now, in part B, it says, let's convert that earnings to the accrual basis of accounting. And all we're given is year-over-year balances of selective assets and liabilities. So let's take a look. So what I'd like to do is show you, first of all, revenue. Okay? So revenue under the cash basis, so we're doing part B, equals 156. So we're going to try to convert it to accrual basis of accounting. So what balance sheet account affects revenue? So the first thing I see is I see accounts receivable. And what I see here is that they had an ending accounts receivable in 2008 of $3,200. And the end of the year balance in 2009 is $2,900. And so this is how we're going to analyze these changes. So you'll see that this ending balance, 3,200, in 2008, that's the ending accounts receivable. You have to assume that in 2009, that would have already been collected. So that's already part of this number, 156,200. So if you think about it, this 3,200 ending balance receivable would have been earned in 2008, and that's the result of why we're setting up as a receivable, because we've already recorded that as revenue under the accrual basis in 2008. So as a result, what we're going to do is we're going to subtract 3,200 from this, because remember, we're trying to convert the cash basis of revenue to the accrual basis of revenue. So here we're going to deduct 2008 accounts receivable. I'm going to short form that as AR, ending balance. We're going to subtract it from the 156 because presumably it's part of this number, but it was already earned in 2008. And the 2009 receivable would have been something that we haven't collected, so it's not part of the 156, but it would have been earned in 2009. So we're going to add the ending balance accounts receivable of $2,900. Okay? Now, what other accounts affect revenue? So if I go through the list of accounts, I can see that unearned revenue is another example of an account, balance sheet account that affects revenue. In this case, we can see that unearned revenue, $1,560, was the balance in 2008, and $1,400 was the balance in 2009. In 2008, you'll see that the ending balance of $1,560 meant that we would have received cash at the end of 2008 that would have been perhaps earned. So revenue haven't been earned yet because we received cash in 2008. And under the accrual basis, it would have been earned in 2009. Now, that means that this $1,400 would have been cash received in 2009. It would have been in this number, but it actually hasn't been earned yet in 2009. Perhaps it will be earned in 2010. So here we're going to take the 2008 unearned revenue. We're going to add the 2008 unearned revenue. Okay, and that would be $1,560. And we're going to deduct 2009 because that would have been cash received, okay, in 2009. So it would have been in this number, but it really pertains to revenue that the earnings process is completed in 2010. Now, looking at the rest of the balance sheet items, you can see that those are the only two accounts that affect revenue. So we can certainly add all of these, and we can see that the total revenue is 156,060. So this is the total revenue under the accrual basis. Okay? Now let's take a look at expenses. You can see that the expenses under the cash basis of accounting is 107,800. Again, well, let's take a look at the remaining balance sheet items. So we've already covered revenue and unearned revenue. Let's take a look at accounts payable. You can see that accounts payable had an ending balance of 1640. And that would have been paid in 2009. So it would have been part of this particular outflow, right? So this is an outflow of cash. That would have been part of the payment that was made in 2008. So therefore, what we want to do is we want to add 1640. We want to add it. So we want to reduce the outflow because that would have been an expense that would have been incurred in 2008. Okay, I'm going to short form accounts payable as AP. And of course, 2009 accounts payable was an expense that were incurred in 2009, but will not be paid until 2010. But under the accrual basis, we need to recognize that as an expense for accrual. So I'm going to take 18 for 1810. Okay? Next, accumulative depreciation is the next account. And you can see accumulative depreciation does not result in cash flow. That increase from 15,000 to 17,250 resulted in an amortization or depreciation expense. And under the cash basis, because no cash was exchanged, it wouldn't have been part of this number. So what we're going to do now is we're going to recognize an additional expense in the form of 2009 depreciation. And that would have been the difference between 17,250 from 15,000. So this one is minus 2,250. The reason why I'm adding to the negative because it's essentially an expense. Expense reduces net income. Okay? Next is prepaid insurance. So prepaid insurance states that we had 1,330 of prepaid balance at the end of 2008, and presumably because it's a current asset, those 1,330 would have been expensed in 2009. So we're going to subtract 1,330. That relates to 2008 prepaid insurance, because that would have been paid in 2008, but it's really an expense under the accrual basis in 2009. And now we're going to take a look at a 2009 prepaid insurance. And 2009 prepaid insurance means we would have paid it in 2009, part of this 107,800, but it pertains to future economic benefit for 2010. That's why we are adding it back. Okay, the ending balance. Income tax payable is the same thing. Okay, so income tax payable, the 2008 income tax payable means that we would have paid it in 2009. It would have been part of that number, so we need to add that back because it does not relate to an expense in 2009. And then we're going to subtract the 2009 income tax payable because it would have been recognized as an expense in 2009, paid in 2010. So once again, if we add all these up, we'll see that we've got an expense of 111,060. So net income under the accrual basis equals 156,060 minus 111,060 to give me 45,000. So that's the net income under the accrual basis. And you can see such a significant difference, isn't there? Well, not really significant. It's 45 versus 48,400. Now, the next question says, which method do you recommend? And of course, we would recommend that Northland uses the accrual basis of accounting, not the cash basis of accounting, because we want to reflect how much was actually earned in the current period, irrespective of whether the cash was received or not. And the accrual basis of accounting is what is in the accordance with generally accepted accounting principles for both private and public companies. Thank you.